$9 trillion is a number so large it barely feels real. But replacing old government debt at higher rates can reach your wallet. Think of the federal government like a household renewing a giant loan. When the loan matures, it does not vanish. It is replaced with a new loan. That process is called refinancing, or rolling over debt. The Treasury sells new bonds and repays bonds that just came due. A huge amount of U.S. Treasury debt matures over the next few years. Estimates near $9 trillion matter because the refinancing bill is enormous. The danger is not that every dollar must sit in a vault. New buyers purchase new bonds. The danger is the interest rate on those new bonds. A bond issued near 1% is cheap. A replacement bond near 4 or 5% costs far more every year. Picture a credit card balance with a teaser rate. When the teaser ends, the balance remains. Your monthly payment grows. Higher rates turn yesterday's borrowing into tomorrow's interest expense. Money spent on interest cannot also fund roads, research, defense, or tax relief. Then comes the next question. Who will buy these bonds? Banks, pension funds, mutual funds, households, and foreign investors buy treasuries. But buyers have choices. If they demand a higher return, treasury yields rise until the bonds look attractive. Treasury yields help set borrowing costs across the economy. Mortgage rates, business loans, car loans, and consumer borrowing can move higher too. A higher 10-year treasury yield can raise a home buyer's monthly payment. It can also make companies delay hiring or equipment purchases. Foreign demand adds another moving piece. Japan and China have long owned large amounts of U.S. debt. Their holdings can change because of currency needs, domestic yields, trade flows, or reserve diversification. If foreign investors buy less, other investors must buy more, often at higher yields. Now add a recession. In a slowdown, workers and businesses earn less income. Tax revenue falls, while unemployment support and other safety net spending rise. The deficit can widen just when the government needs to borrow more. That creates a difficult triangle for policymakers. They can cut spending, raise taxes, or borrow more. Each choice has costs, and none is politically easy. The central bank has a separate problem. Cutting rates can support a weak economy, but cutting too quickly while inflation stays high can worry investors about buying power. That worry can show up as higher long-term bond yields. Short-term rates may fall while mortgages stay expensive. This does not mean a sudden U.S. default is the most likely outcome. Treasury debt is issued in dollars, and the United States has deep financial markets. But payment may still hurt. The burden can appear through higher taxes, lower spending, higher borrowing costs, or inflation that shrinks each dollar's buying power. This debt story matters at the grocery store and housing market. It matters in retirement accounts holding bonds. It matters when a local business seeks a loan. The key insight is simple. Debt rollover is not one explosion. It is a pressure system. Each maturing bond is replaced. Each replacement rate affects interest costs. Each increase in interest costs narrows future budget choices. You cannot control the national debt, but you can avoid ignoring interest rates. Keep expensive personal debt manageable. Build an emergency cushion. Review how rising rates could affect your mortgage, savings, and investments. The $9 trillion headline is a warning sign, not a countdown clock. Watch borrowing needs, interest costs, inflation, and long-term yields. Those trends can shape everyday prices before a crisis makes headlines.